All right. Well, welcome everyone. Again, Chad Frantzen. Thank you for being here. This is the September Wealth Builders Investments and Kingdom Finance Show monthly economic update. Thank you for being here. If you're watching this live, we're recording this on September 24th, 2024. Please put your questions in the webinar chat feature. I'm also going to put in the webinar chat a scheduling link which you can use if you have questions, you want to talk to our team at Wealth Builders Investments about any of the topics that I cover today, or if you're a prospective client, current client, we'll be happy to visit with you. So if you're watching the webinar live here on September 24th, 2024, go to the webinar chat, and in there you'll see a link for a phone consultation. If you want to join that, you can connect with myself and the team, and we'll be happy to talk specifically on any questions that you have today. So again, we are going to probably go about 45 minutes today. We're recording this at 4 o'clock p.m. Mountain, 5 o'clock Central Standard Time. I will leave space in the program to answer questions. Again, the Q&A function is probably going to be the best place for you to ask your questions on that. So, and I will also put that link in there. Thank you, Laura, for letting me know that. So let me put I'll put that in the chat as well for everyone. All right. Well, we've seen a lot happening in the markets today and this past week. We're recording this the week after the Federal Open Market Committee, the FOMC, headed by Chairman Jerome Powell, lowered interest rates for the first time in quite a long time, to say the least, on that. So, I have a few slides I'm going to show you, but really there's three main themes that I want to cover on today's program. Again, this is our monthly economic update, so we're really going to talk all things stock market, capital market here in the U.S., and the economy. Now, if I were to boil what I'm going to share with you down to three things, the three main things, and that way, if you're taking notes at home, is the three key points are: number one, that the Federal Reserve has cut interest rates by 1/2 of a percentage point, or 50 basis points, on September 18th. That lowered the federal funds rate from 5.25 to 4.75 as an overnight lending rate. In response to that, stocks and cryptocurrencies went up, but mortgage rates and bond yields also went up. We'll talk more about that. Point number two, we have officially moved, in our opinion, from a slow growth, slow inflation environment, which we call Quad 4, and I'm going to teach that, to a slow growth, increasing inflation environment, which we call Quad 3. I'm going to teach that to you. Point number three for the September economic update is, going into 2025, after the presidential election, we expect that inflation will go back up. Potentially within the next 3 to 6 months, it will reaccelerate. Those are your three key points. If you learn nothing else, that's the major takeaway. What I'd like to do with the rest of our time on the webinar today is I want to go through a few slides and really teach you. I'm going to give you my personal opinion. Again, I'm not giving you personal financial advice on this webinar. Happy to do that in a one-on-one format. Our team, you can schedule a call. If you're watching this and you've registered for this event, you will get this webinar recording in a follow-up email. It'll probably go out tomorrow. So you'll have the full recording if you're jumping on late, or if you have to cut out early. Again, we're going to go about 45 minutes. But I encourage you to stay as long as you can. You will get this recording in an email probably tomorrow, next business day, and you'll have a link in that email to schedule a call with our team if you like. So with that, I'm going to share my screen. I'm going to go over some of the slides that I have put together for this month's economic update. All right. Well, there has been a lot going on in the markets, to say the least. Again, you can find us online at wealthbuilders.net. I think everyone knows that. Um, but interestingly, well, this is not interesting, but let me give you my legal disclosure for this webinar. This content is for educational purposes only. These views reflect our personal opinion. I'm not here to give you tax or legal advice, and encourage you to consider your risk tolerance before investing. So enough with the legal disclaimers. Let's jump right in. If you don't already follow us on social media, please connect with us on the Kingdom Finance Show. You can find that on all your major podcasting outlets, from YouTube to Apple to Spotify. We drop an episode every week talking about investing with biblical values and also analyzing the economy and the markets to help you make sense or get clarity out of chaos in an ever-changing world. So you can snap that QR code or just go look for us on social media under the Kingdom Finance Show. All right. If you were with us on last month's webinar, we did talk about this chart right here. Now, this chart is the federal funds rate going back to 1954 through the end of last year. Now, what you will notice in the chart is that the interest rates fluctuate pretty wildly, right? You can see the top of that blue line is the late 70s, early 80s, when interest rates were very, very high. Now, you also see that interest rates were higher in the mid 2000s, leading up to the financial crisis of 2008. And you also see here in the far right hand of the chart where interest rates were almost zero for several years. And then, of course, after COVID, during COVID, they went down. Now, what you see on the far right-hand side of the chart is interest rates. The Fed, the Federal Reserve, raising the lending rate to stabilize the economy, cool down the economy, if you will. But now what's happening is rates are starting to roll over. Now, as a follow-up to that chart, what I'm going to show you is this is my new chart for the day. And this really is my point number one for this month's economic webinar. So let me kind of read through this chart and then we'll talk about it a little more. The U.S. Federal Reserve released their September dot plot chart, which is what I'm showing you here. And the summary of this is that they did cut interest rates 50 basis points, or 0.5%. And the decision, according to Chairman Powell, was based on economic data, including the July labor market report, which we talked about last month. And he stated that if they had seen that data before the July meeting, they might have started cutting interest rates then. The Fed consists of, I believe, 19 board governors, and they all vote when they meet, 8 to 10 times a year. They vote on monetary policy. And as all of you know, I've shared this before, whether you are an entrepreneur, a retiree, a teacher, a stay-at-home mom, a student, the money supply and monetary policy affects us all because it dictates how fast money runs through the economy, how much it costs to finance a home or a vehicle purchase, how much it costs to get a line of credit for your business, to start a business, expand a business, things of that nature. So this dot plot chart is really helpful, and I'm going to go through it a little bit more. Now, the main thing to look at here is that of the 19 participants, they also projected that inflation would be at 2.3% at the end of 2024, and that the U.S. GDP, which is gross domestic product, just a fancy way of saying how fast is the economy growing, that it would grow at a 2% annual rate by the end of 2024. Now, the inflation projection was actually lower than what they had put out in June of this year. In addition, the FOMC, Federal Open Market Committee, and again, I apologize, this is a little technical in nature, but for this month's webinar, I really want to dig into what the policymakers are looking at and how they're communicating it to the broader public. The FOMC, they expect a higher year-end unemployment of 4.4%, which is higher than the 4% they projected in June. So the Board of Governors are expecting inflation to be a little lower by the end of the year, but expecting unemployment to be higher. Now, what this chart shows us is that the federal funds, this dot plot chart, if you look at it, you will see that the year-end column there, that first column, right? You'll see a whole bunch of blue dots there. So that is every board governor's vote. So they all vote on where they want rates to be, and then you kind of pick the middle of that. So what we're seeing, and this projects it out over the next 3 years. So this is helpful if we're trying to forecast where interest rates will be, whether you're a small business owner, whether you are looking to purchase a home or an investment property. This is really valuable data to know. Now, what the Fed Funds has projected is that between now, the fourth quarter, we're almost in the fourth quarter of 2024, and the end of 2026, is that the interest rate is going to go down to around 3%. Now, what you'll see here is that we do expect, based on how the governors have voted, seven of these board governors are predicting a vote for interest rates around 4.5% by the end of the year, and another 9 are actually projecting interest rates to be closer to 4.25. So what that tells us, what this chart tells us, if you say, Chad, okay, this is not as cool a chart as you think it is. The biggest change here from September and June is that the Fed is now projecting that they will cut interest rates an entire 1 percentage point by the end of calendar year 2024. Now, that's a little bit higher than what they were projecting back in June when we looked at this chart last. So use some simple fifth grade math, 1 percentage point. They have already cut interest rates 1/2 of a percentage point. So this data tells us that they're going to cut rates another 1/2 percentage point between now and the end of the year. The Federal Reserve does meet 2 more times, the week of the presidential election, and then they meet again mid-December as well. So we expect at this point another 50 basis points of interest rate reductions by January 1st, 2025. So that will get this federal lending rate down from 5.25 all the way down to potentially 4.25%. As of today, as of the recording of this webinar, September 24th, 2024, that federal rate is at 4.75. So that's important data for us to understand with what's going on with interest rate policy, monetary policy on that. Now, the next chart I want to talk about here, I've got a couple charts here, and then I'll leave some time for Q&A at the end as well, is point number 2. Point number 2 is that a lot of people ask us about mortgage rates and lending rates and things of that nature. And this is a chart of the 10-year U.S. Treasury yield. Now, the key to understanding mortgage rates is to focus on labor and economic data, not so much interest rate cuts. Now, the 10-year Treasury yield, which you see here, it got as low as 3.6%, but then housing starts data came out. Housing starts beat estimates. Single-family permits data showed that they're growing again. And believe it or not, the 10-year U.S. Treasury, which is not directly linked to mortgage rates, but the bond market is very much a predictive indicator. It usually figures things out before they happen, if you will. Now, when I said in my opening of my three things that mortgage rates and bond yields both went up after the Federal Reserve announced that they were cutting rates. Now, that may sound crazy, all right, because that would not be intuitively what you would think. We would expect stock market and crypto to go up after the announcement of a rate cut, which they have. But what we have to understand is that the bond market is way far ahead of the Federal Reserve. And what you can see in this chart is that this red line is the yield on the 10-year U.S. Treasury bond. And this data is from Housing Wire. It's through the Board of Governors of the Federal Reserve. And what you'll see is that going back really over the last several months, that the yields have gone down. So the bond market was already predicting that interest rates at the federal level would have to be cut. And that's what we've been talking about here on these economic updates is, rates are going to have to come down. The measure by which they do is what we don't know. Now, curiously, if you look to the far right-hand side of my chart here, you'll see that that red line starts to go back up. And that is what I'm talking about, is that the bond market was already predicting rate cuts, and now bond yields are actually going back up. And I'm going to show you another chart here in a second. If you follow mortgage rates, just national average 30-year, 15-year conforming mortgage rates, they had already been coming down before the Fed met on September 18th. Some of you may know this. Some of you may be purchasing a primary residence or an investment property, and you may know, hey, yeah, Chad, I've seen, rates have been coming down. I was able to lock in a lower rate for something I'm doing. But now we're a week after the Fed meeting. Bond yields are going up. Mortgage rates are ticking back up, albeit mildly. Crypto's going up, stocks are going up, and gold is going up significantly. Gold, in fact, I don't even have a chart for this, but gold is almost signaling that we're in a recession. So a lot of interesting moving parts here in the capital markets, if you will. The bond market does get ahead of the Federal Reserve, and so the Fed is just catching up to what the bond market is telling it. So this is one of the charts that the Fed looks at among many other things, right? And so let me speak to, the mortgage rates just a little bit here. National average on mortgage rates. I just grabbed these online. Again, I know they fluctuate regionally for sure, but just for this webinar today, this was current as of September 23rd. The 30-year fixed rate mortgage was 6.65. Now, a week ago, before the Fed's announcement, it was 6.61. So it's gone up 4 basis points. Not a huge change, but my point is I want to educate you, as some people think when they read or hear that the Fed cut rates, they think instinctively that, oh, great, now when I go talk to my mortgage person or my real estate person or my banker, rates are going to be lower tomorrow. Well, not necessarily. It depends. In fact, the bond market is a predictive indicator, and so mortgage rates and the 10-year bond have been kind of going down, pricing in these rate cuts. So it's not surprising for us to see that mortgage rates, you might think, well, gosh, mortgage rates were 6.6% on a 30-year national average, of course. And after they cut rates, will they go down a 0.5 percentage point? That's not how it works. And you'll see the 15-year conforming mortgage as well. It went back up about 2 basis points. So not a huge change, but instinctively, if you're thinking, well, gosh, mortgage rates are going to be lower next week now that they cut interest rates, a lot of that's already been priced in or baked into the markets. Still very positive that rates are going down. So a common question we get is, okay, Chad, what, in your opinion, needs to happen for mortgage rates to go lower than where this chart has them at? We understand that the Fed has cut rates, but what needs to happen for mortgage rates to go down more on that? Well, what needs to happen is probably a combination of three things. One, mortgage spreads need to get better. Number two, which we talk about a lot, is the economic and labor data needs to get softer. This is the key thing that the Federal Reserve is looking at. They're looking at the economic and labor data, jobs created, unemployment, those type of things. That's a big part of this policy. And then number three, I would say, in order for mortgage rates to go lower, number three is the Fed needs to get more what we call dovish with their statements, which means dovish just means in our world, it means they're willing to cut rates as frequently as possible, maybe even more 50 basis point cuts as opposed to 25 basis points. They're willing to do whatever's needed to keep the economy from staying out of a recession. Now, the stock market is acting at these all-time highs. It's acting like we've already had a soft landing, and the gold market's acting as if we are in a full-blown recession. Now, both of those capital assets cannot be correct. What remains to be seen is how does this work out? And I do think parts of the economy are in a recession. Again, recessions are only declared in hindsight when you're looking through the rearview mirror on that. All right, well, let's move along. I've got a couple more charts. I hope this is helpful. Again, I know it's technical because we want to do the economic update, but we'll be happy to talk with you one-on-one on how to apply this personally. Now, point number three in my three key points, so this is point number three, is that when you look at the economy, and I'm talking about the U.S. economy here, there's really, if I were teaching this in a classroom setting, I would show you this square, and I would break this square into four quadrants, if you will. So if I boil down the economy to two things, at the top here, you see it says GDP growth. That just means, is the economy, is the U.S. economy, is it growing? Is it increasing? Or is it decelerating? Is it decreasing? And that's going to put the economy either in box 1 or box 4. Now, the second part of the equation is inflation. Now, is inflation going up? Is it increasing? Or is it decreasing? Okay, so you'll see that box 4 is highlighted. We call these quadrants, so this would be quad 4. So in quadrant 4, the economy is decelerating. It's not growing as fast as it has been. It may still be positive growth, but it's starting to come down. It's not negative, but it is starting to decelerate for sure. And in this case, it's not negative. It could be, but in this case, it's just decelerating. Again, we mentioned around 2% is what the Fed expects the economy to grow at. And then inflation is going down. So what we have been in for a good part of 2024 is what we would call quadrant 4. Economic growth is decelerating and inflation is decelerating. Now, our point, my opinion, as well as some other analysts that I follow, is we believe September, the actions this month, and now going into Q4 is that we're going to be moving into quadrant 3, which means the economy is continuing to decelerate and inflation, and I've got two charts I'm going to show you all. So bear with me, is inflation is going to start to increase. Now, the Fed has said the core inflation number they're projecting to be at, was it 2.3, 2.5 by year end? But we know, real inflation is very different from what the government reports on. There's a lot of the things that inflation is pegged at that we have to spend as families and business owners and so forth. So what's happening is asset prices are rising across the board. The US dollar is getting weaker, and the Fed is becoming dovish. They're saying, hey, we'll lower rates at whatever measure we need to keep the economy out of a recession. Now, when you move from different quadrants, the economy could be in a different quadrant 2 or 3 times a calendar year, just to be clear. it's not like this stays static for a whole year or two. And in fact, I have some charts, which I don't have time to show you today, but it's not uncommon for it to bounce around from maybe two or three of these quadrants in a given year. Now, the point of that, of being a responsible investor, is making sure you have a financial plan and an investment strategy that's going to be in the right type of assets, in the right measurement that meets your suitability, your age, your tolerance, all those things, based upon where the economy is, if it's in quadrant 4 or quadrant 3 or quadrant 1 or 2. Now, the Fed Chairman Powell said last week that they've made, quote, real progress on inflation. But following the Fed's decision to cut interest rates by 50 basis points, there was a large number of commodities that went up in price. So this is another chart I want to show you. So again, we think intuitively the Fed cuts rates, so well, inflation should go down on things and lending rates should go down. I've already talked a little bit about mortgage rates and the bond rates and how they're already ahead of what the Fed's doing. It doesn't mean they're going to drop 50 basis points, as it were. Now, this chart is from Hedge Eye Risk Management, and this talks about what we call the Fed-induced real-world inflation of asset prices. And this is why we would tell you that we are moving into quadrant 3 of the economy. And so that's going to impact what type of investments we do. I'll show you a chart with some examples. Again, I'm not giving you financial advice on how to invest today. I'm really just trying to show you what the economy is doing, what policies are, and what we think it's going to be going forward. Now, this chart from Hedge Eye, this is just looking at some of the commodity indexes in the 1 week since the Fed met and cut interest rates by 50 basis points on September 18th. Now, what you will see is that crude oil was up almost 5%, copper is up 2.5%, natural gas is up 6%, sugar is up 17%. This is just in the last 7 days. If you look to the far right here where my cursor is, you'll see that vertical gray column. That is September 18th, 2024, when the Fed cut rates. And you'll see what some of these commodity prices, sugar, natural gas, copper, crude oil, just the overall what's called CRB index, the overall commodities. These are all turning bullish, which can potentially be good as an investor, but it also means that inflation is what we call reflating. So this is a big part of our thesis, is that the Federal Reserve likely is going to come out in the next 3 to 6 months and say, we had no idea that inflation was going to kick back up, but we already have the data 1 week after they cut rates that a lot of these commodity prices, which go into when things are manufactured and transportation and goods, they go into the cost of goods sold. And so that tells you right there that asset prices are going up, which is going to increase inflation. And that's pretty incredible that something like sugar could go up 17% commodity price just in 1 week. It's really, really phenomenal there. Well, so that's really point 3. Point 3 is that we are moving into a reinflating environment, and that's going to influence how we invest a little differently. I want to show you, this is a chart I had from last month's economic update. We did a study on just what overall inflation has been since the Biden administration took office. Obviously, gasoline prices some 50% higher over the last 3.5 years. Groceries, we've talked a lot about this, 20 to 22% on that. That certainly hits home with a lot of people. It's amazing to me what my grocery bill is when my wife comes home with our weekly groceries on that. Eggs, car insurance. Your car insurance, if you've gotten a renewal lately, car insurance has just gone through the roof. I think one of the better companies or business models to invest in is some of these insurance companies, because they are great at collecting premiums, raising premiums, and then denying claims. And I know Warren Buffett owns several insurance companies, but car insurance premiums, national average, up 54% in the last 3.5 years. So this obviously affects middle America, affects us as everyday investors on that. Now, I want to share one other chart here. Again, I'm not giving you investment advice. I'm just showing you some examples when you move into different quadrants. Again, we've been in a quad 4 environment, and this is my last chart. Um, and quad 4 is what we call more of a deflationary environment. We're moving from that into what we call quad 3, which is, I call it reflation. You could also think of it as stagflation. I've taught on stagflation in the past. Stagflation is where inflation is going up, and the economy's growth is coming down on that. So we're moving from this far right column to that second column from the right. So again, there's going to be all different types of asset classes that will historically be better when you're in these different types of environments. So we've already talked about commodities and gold. Those have historically been really strong assets when you're in this quad 3 environment. You also see things like utilities and energy, healthcare. Some of those defensive assets tend to be really good in quad 4 and quad 3 on that. So you typically don't do as well in some of the other asset classes like small caps and communications and financials. But again, I don't have time to unpack all this. I just want to show you this more as a teaching tool that when you're creating an investment strategy, you might be thinking, okay, Chad, this was a lot of heady information. What we want to do is just make thoughtful decisions on our investment strategy. And this is an example of what we do at Wealth Builders Investments with our investment portfolios. Now, every client's different. Every client has a different situation, different age, different tolerance, different goals, different amount of resources. But again, this research, this is through Hedgeye, just gives you some example of historically what type of asset classes to look at on that. So I hope that is helpful for everyone. What I want to do now is kind of summarize some of this for you all. I've already shown you that slide. I am going to put, you are going to get in the chat and in the follow-up email, you're going to get this scheduling link. Our team would love to connect with you if you'd like a 15, 20-minute call. If you're a current client, thank you. We appreciate the opportunity to serve you. If you want to connect more and just hear what we're doing with your portfolios, or if you're a prospective client, maybe if you've followed us through Kingdom Finance or other networks, and you want to learn more about how to apply this to our strategy, we'd love to connect with you as well. So really, in summary, the Fed, as expected, cut interest rates. I personally was of the opinion that it would be a 25 basis points cut. That's what I had shared in August, and I thought they would probably cut 2 more times. I was kind of thinking they do 25 basis points for the last 3 meetings, but they've obviously gotten enough data that they're going to be a little bit more aggressive on that. So that does make me a little concerned that potentially the data is not as good as they want it to be. But nonetheless, regardless of Fed policy, and I'm going to get to some questions here, so please put your questions in the Q&A, and we'll wrap up with some Q&A here. Regardless of if policy is neutral or whether it's tightening or whether it's loosening, if you have a well thought out financial plan that's in line with your values, again, we really promote having biblical values in your framework. If you're running a business, if you're running a ministry, whatever the case may be, that you can make some well thought out decisions on what to invest in and when and how on that. So I hope that's helpful. Let's take a look at some of the questions here. Does the Federal Reserve use calendar quarters or fiscal year quarters? They're looking at calendar year quarters on the data. A lot of the employment and inflation data, it comes out every month. Usually at the end of the month, you'll get that from the previous month on that. The curious thing is some of this economic data, and we shared this, I can't remember if it was in July or August, but some of the jobs that had been reported as being created going back, the last 12 months. They came back 12 months later and did a revision and said, well, we didn't create as many jobs as we thought. So there are what we call revisions in this economic data for that. But clearly the Fed is really driven by the labor market and what's going on, which leads to another question from Brett. How will the runaway immigration numbers affect the unemployment rate and the economy over the next couple of years? Great question. And really, what's happening is runaway immigration. A lot of those people are going in and they're getting a lot of the blue collar jobs, right? And that's taking away employment from everyday folks, hardworking blue collar folks who are truly citizens, tax paying citizens on that. Now, so it has the potential, which I think it's already doing this, to actually kick people out of the job market who otherwise would have jobs, who are maybe lower income, lower middle class people who have, whether it's a construction job or whatever the case may be, but good, dignified work. A lot of those people are now going to show up on the unemployment numbers that come out every month. So I do think that's going to increase the unemployment numbers, which the Fed looks at, because a lot of the undocumented people who are in the country are going to be taking those jobs. Now, what that means is that hopefully the Fed will be accommodative on interest rate policy over the next couple of years, because if it's not, it could lead us into the greater threat for a recession, because unemployment is higher. Great question on gold. Is the rise in the price of gold due primarily to the weakening dollar, or is it more intrinsic? Well, it does have to do, great question, Mark. Thank you. It does have to do with the weakening dollar. The dollar is weak. It's part of the reason why we view the economy in that quad three, because you have a weakening dollar, you have inflation, real asset prices going back up, and you have a Fed that's very dovish, accommodative. So the dollar being weak is bullish for gold, but also the gold market is really insinuating by its pricing, how it's trading, that we are in a recession, that we're already in a recession. Now the bond market, it has some mixed signals there. The stock market saying the exact opposite on that. I think intuitively, people will always want to have some allocation to gold in their portfolio. That is my personal opinion. I do think having some commodities, which you've heard us talk about today on the show, I do think gold being one of those commodities. I do think commodities play a part. They don't pay a dividend. They're not doing distributions. But if we're talking store of value to maintain asset prices, commodities, I think, are going to continue to be bullish as long as the economy is in this, what we call the quad three or quad four of the market. I don't see any other questions on that. Again, let me summarize. If you have one last question, we've got a few minutes here. I think we'll do another webinar next month before the election. We'll talk a little bit more about the election and implications of the markets, depending on whether it's a Trump or Harris presidency going into 2025. There's a lot of different proposals on the economy and tax legislation on there. And so we'll talk about that in the October show, which will be our last one before the election. So please be on the lookout for an invitation to that. We'll be talking all things presidential election and policy on that. We've been getting a lot of questions from clients and friends on that as well. We've got another question that came in from Sully. Hey, Sully, if you're going to invest in real estate over the next 2 to 3 years, is it worth waiting a while, or go ahead and purchase, or wait for lower interest rates going into later 2025? Well, I'll give you the attorney answer, right? It depends. Real estate is a very localized market, as we all know. And so, someone in Texas may find a deal to develop some land or a duplex that has a distressed seller. The key part with real estate is you can always find an opportunity to invest. You just have to have the right metrics, the right formula for it. It's a little different with gold and crypto and stocks where it's not an efficient market, but it's not like I can go out online and say, hey, I want to buy Nvidia for, $100 a share, or I want to go buy Tesla for $100 a share, and it's, trading at 200. Well, that doesn't happen that often unless someone has a margin squeeze. But I do like real estate. I think it is being very challenging from people I've talked to across the country and in the Wealthbuilders community to make some of the formulas work right now. Right, just to make the numbers work with interest rates being higher and a lot of the prices still being high. But I do know people who, if you find a motivated seller in a market where there's not a lot of bids, with rates being higher, there have not been as many buyers. There are some opportunities where you've got a motivated seller. We're moving. We've had a death in the family. We've had a job relocation. Right. We've had another child, and we have to move to a bigger house. That's one of the great things about real estate. There's always there's always opportunities there, and it does vary by city, by state on that. So I do like it. I would just caution people, make sure you're really looking at the numbers for it, because there's a couple different scenarios where I don't see real estate going down 30%, but I do think we make our money when we buy, whether it's in stocks or crypto or land or real estate on that. Well, great. Well, I appreciate you being here. Thank you for being a part of our community. Again, if you're a current client of Wealthbuilders Investments, I want to say thank you for your trust and confidence in us. If you have any questions, please feel free to connect with us. You will get a link in your email to set up a call with our team. But hey, if we are already working with you, I know several of you who have asked questions we're already working with, just shoot us an email or a call, and we'll be happy to connect with you. So with that, let me wrap up today's webinar. Again, the three main points are that the Fed has finally cut rates 50 basis points. We expect them to cut another 50 basis points between November and December's meeting. So by January 1st, we expect that federal rate to be closer to 4.25%. Number two, we've officially moved from what we call a quad 4 economy to a quad 3 economy, which means the economy is still slowing down, and inflation, as I've shown you in those commodity charts, inflation is actually starting to kick back up on real asset prices. Now that stinks for a consumer, but for an investor, there's an opportunity. And finally, we do expect that to be a major theme for 2025 is higher inflation of asset prices. And of course, mortgage rates and bond rates have already predicted a lot of what happened last week before it happened. Well, thank you guys so much. Again, you'll get an email with the recording. And if we can help you in any way, please let us know. Please subscribe to the Kingdom Finance Show. And I appreciate you being here for the September edition of our economic webinar update. We'll see you next time. Thanks so much.
Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. Content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.